Before we begin, I want to invite you to subscribe to this channel. Here we focus on thoughtful, disciplined financial thinking, the kind that builds wealth over time, rather than chasing quick wins. If you're serious about understanding markets and managing your financial life with intelligence and clarity, subscribe now and you'll receive regular insights designed to help you think independently about money. Subscribe button in red color appears on screen. Our community is built on one principle. Financial wisdom comes from calm analysis, not emotional reaction. Let's think together. Good morning. We're living through an extraordinary moment in the precious metals markets and specifically in silver. Something unusual has occurred, something that deserves your attention, whether you're a current holder of silver, a potential investor, or simply someone who wants to understand how modern financial markets actually function. A significant trading anomaly has surfaced in the silver markets. Investors have been formally alerted by regulatory observers and market analysts. The question before us is not whether this happened, it did, but what it means for you, how you should think about it, and what preparation looks like in an environment where such disruptions are increasingly possible. This is not a moment for panic, neither is it a moment for complacency. It is, instead, a moment for clear thinking. Over the next 25 minutes, we're going to walk through what happened, why it matters, how professional investors are responding, and most importantly, what you can do to protect your interests and position yourself rationally in markets that are becoming more complex and at times more unpredictable. To understand what went wrong, we first need to understand how the silver market is supposed to work. Silver trades in multiple venues simultaneously. There is the spot market, where physical silver is bought and sold. There are futures contracts on major exchanges like the COMEX, where large institutions and professionals trade standardized silver futures. There are over-the-counter markets, where dealers and institutions negotiate private transactions. And there is the retail market, where individual investors like yourself can purchase silver bullion, coins, and bars through dealers. These markets are meant to move together. They are connected by a principle called convergence. When futures prices diverge significantly from the underlying spot price, arbitrageurs, traders who profit from price differences, step in and trade one market against the other, forcing the prices back into alignment. This interconnected system has worked for the most part for decades. It is not perfect, but it has maintained a basic level of integrity and orderliness. What we've witnessed recently is a disruption in this carefully balanced ecosystem. Let me be direct about the nature of the glitch. Certain trading platforms and systems that feed market data or execute trades experience significant malfunctions. Orders were not processed correctly. Prices appeared on some screens, but not others. There was, for a temporary window, a breakdown in the unified information flow that allows all market participants to see the same prices and execute trades on the same basis. When you have thousands of traders operating on different information sets, connected to different venues, with their trades flowing through different electronic systems, even a small breakdown in synchronization can create opportunities for manipulation, error, and loss. Some investors received margin calls, demands for additional capital, because their positions were marked at prices that diverged sharply from reality. Some orders that should have been executed were canceled automatically. Some traders faced situations where the price they saw on their screen bore no relationship to the actual market price they would receive. This is not theoretical harm. Real money was at stake. Real investors experienced real losses, or at minimum, real fear and uncertainty about whether their positions were safe. Regulatory bodies have stepped in. The CFTC, the Commodity Futures Trading Commission, is investigating. Market operators have issued alerts and advisories. Transparency has increased. The systems have been reviewed and, in some cases, modified or upgraded. But the fundamental question remains unanswered. How is this possible? And will it happen again? Silver has become increasingly important to a broader set of investors in recent years. This is not because silver mining output has changed dramatically, or because industrial demand for silver has surged beyond historical norms. Rather, silver has become a focal point in a larger conversation about monetary policy, inflation, market stability, and the reliability of traditional financial institutions. Many investors see silver as a hedge against currency debasement. Some view it as insurance against broader market instability. Others see it as an undervalued industrial metal with legitimate supply constraints. Professional investors, family offices, and institutions have significantly increased their silver positions or added silver to their portfolios over the past 5 to 10 years. This increase in demand and interest has brought a larger, more diverse group of participants into the silver market. Many of these participants do not have the institutional knowledge or experience that, say, a professional trader at a major bank might possess. They rely on retail platforms, online brokers, and dealer networks that are not always as robust or as well capitalized as professional trading infrastructure. At the same time, the silver market itself, while significant, is not as deep or as liquid as equity markets or even some other commodity markets. This is important. When a market is not very liquid, meaning there aren't enormous supplies of buyers and sellers at every price point, disruptions can have larger effects. A relatively small order can move the price. A small glitch in a major execution venue can create cascade effects. So we have a situation where a larger and more diverse group of retail and semi-professional investors are participating in a market that is relatively illiquid and technically complex. Trading happens on systems that, while sophisticated, are not immune to errors. The infrastructure is interconnected, so a failure in one place can spread to another, and the regulatory oversight, while present, can sometimes lag behind the speed and sophistication of modern trading systems. This is the environment in which the glitch occurred, and it is the environment in which it could occur again. We need to remember that this is not the first time something like this has happened in financial markets. It is not even unprecedented in the silver market itself. In 2008, during the financial crisis, multiple markets experienced severe disruptions. Trading was halted. Bid-ask spreads, the gap between the price buyers will pay and the price sellers will accept, widened dramatically. Some markets were essentially frozen. In 2010, an event known as the flash crash caused the entire stock market to drop nearly 10% in a matter of minutes. The root causes were later identified as a combination of algorithmic trading, circuit breaker failures, and unclear communication between different market participants. It was extraordinarily brief, but it demonstrated that modern markets could experience sudden, severe disruptions. There have been multiple incidents involving commodities markets, currency markets, and fixed income markets. Each one revealed weaknesses in the infrastructure. Each one was followed by regulatory review, system upgrades, and promises that it would not happen again. And yet, here we are with another significant glitch. This should not be shocking to you. It should, instead, inform your thinking. Modern financial systems are complex. They involve hundreds of companies, thousands of individuals, and millions of lines of code. Complexity creates vulnerability. The larger and more interconnected the system, the greater the potential consequences when something breaks. When disruption occurs, something important happens in the human mind. Fear activates. You might be holding silver, and you see a price on your screen that is utterly different from what you saw 5 minutes earlier. Your immediate response is not to calmly analyze what's happening. Your immediate response is survival instinct. Is my money safe? Should I sell immediately? Is this a sign that everything is falling apart? This is not weakness. This is biology. When we perceive threat, we activate our fight or flight response. We want to act. We want to move. We want certainty. But in a glitch situation, acting immediately is often exactly the wrong thing to do. The glitch often corrects itself within minutes or hours. The prices you see that are wildly out of line often snap back to reality. If you sell in panic during the glitch, you lock in losses that may have been temporary. You act on false information, and you cannot undo the action once the information becomes clear. Professional traders are trained for this moment. They have rules. When something seems obviously wrong, when a price moves 20 or 30% in a few seconds, they pause. They check other venues. They verify that the data is real. They do not act on the first impulse. As a retail investor, you may not have this training, but you can adopt this discipline. You can build it into your personal investment rules before a crisis occurs. What we call emotional discipline is nothing more than the commitment to follow rational rules even when fear is activated. It is possible for you. It requires only intention and practice. To understand where we are right now, we need to zoom out and look at broader market cycles. Silver, like all commodities, moves in cycles. These cycles are driven by supply and demand, but they are also amplified by investor psychology and macroeconomic conditions. From 2001 to 2011, silver experienced an extraordinary bull market. Prices rose from around $4 per ounce to nearly $50. This was driven partly by industrial demand, partly by investment demand, and partly by the broader commodities supercycle that was fueled by emerging market growth and historically low interest rates. From 2011 to 2020, silver entered a prolonged consolidation and bear market. Prices fell back to the $15 to $20 range. Many investors who bought near the peak in 2011 suffered substantial losses. Some held and waited, some sold and exited the market entirely. From 2020 onward, conditions shifted again. Central banks across the world cut interest rates to zero. Governments implemented extraordinary fiscal stimulus. Money supply expanded dramatically. In this environment, investors began to reconsider commodities and precious metals as a hedge against currency devaluation and inflation. Silver prices rose sharply. They broke through previous resistance levels. Investment demand surged. Retail investors, who had largely abandoned precious metals during the 2011-2020 bear market, returned to the sector. We are now in a period where the silver market is attracting more participants and more capital than it has in years. Prices remain elevated relative to historical norms, but they are also volatile as the market tries to find its equilibrium. The underlying economic situation, inflation concerns, central bank policy, currency stability, remains unsettled and uncertain. This is the background against which the glitch occurred. We are not in a stable, boring market with a small number of routine traders. We are in a heated, volatile market with strong flows in and out, and new participants who may not fully understand the risks. The glitch did not occur in a vacuum. It occurred in a specific macroeconomic moment, and understanding that moment is essential to understanding whether this kind of disruption is a one-time event or a sign of things to come. We are currently in an environment of elevated inflation, persistent uncertainty about monetary policy, geopolitical tension, and structural changes in how money flows through the global system. Interest rates, after being historically low for more than a decade, have risen sharply. Central banks are tightening policy, meaning they are reducing the supply of money and credit. This is creating stress throughout the financial system. Not catastrophic stress, but noticeable stress. Banks are being tested. Commercial real estate is facing challenges. Deposit flows are unstable at some institutions. The government bond market, which is supposed to be the safest asset class, has experienced unusual volatility. In this environment of stress and uncertainty, vulnerabilities in market infrastructure become more visible. When money is abundant and volatility is low, everyone makes money, and small problems go unnoticed. When conditions tighten and volatility increases, small problems become catastrophic failures. The silver glitch is one symptom of this broader stress in the financial system. It suggests that infrastructure that was built and tested during a period of relative calm may not function properly during periods of elevated stress and higher volumes. This is important for you to understand because it means that more glitches are possible in the future, not certain but possible. The structural conditions that allow glitches to occur are still present. The technical vulnerabilities that we discovered through this glitch may have been fixed, but similar vulnerabilities almost certainly exist elsewhere in the system that we have not yet discovered. Regulators have responded to the glitch. The CFTC has stated its intention to investigate. Market operators have issued guidance to their participants. There is talk of additional circuit breakers, position limits, or reporting requirements. This is appropriate. Regulation plays an important role in maintaining market integrity. But we should be clear-eyed about what regulation can and cannot do. Regulation cannot eliminate risk. It cannot make the financial system perfectly safe. What regulation can do is establish rules, enforce transparency, and create accountability when those rules are broken. It can also establish circuit breakers, automatic stops that prevent prices from moving beyond certain limits in a given time frame. But here's the problem. Clever people are constantly finding new ways to work around regulations. And the rules themselves must be written by regulators who, by necessity, are always somewhat behind the curve in understanding the latest innovations in trading technology and market structure. Moreover, regulation works best when it is enforced consistently and quickly. But enforcement is slow. Investigations take years. By the time a regulatory action is complete, the market has moved on and new vulnerabilities have emerged. So regulation is helpful, but do not count on regulation as your primary protection. Instead, count on your own discipline, your own due diligence, and your own rules about how you will behave in times of stress. If you already hold silver, either as physical bullion, in a certificate, or through a fund, the glitch raises some important questions. Let's address them directly. Do you know, with specificity, where your silver is located? If you hold physical silver in your home or in a safe deposit box, this is straightforward. If you hold it with a dealer or custodian, can you verify that the silver actually exists and is actually yours? Some investors hold silver through unallocated accounts, meaning the dealer holds a pool of silver, and you own a claim to a certain amount of it, but not a specific bar or batch. This is lower cost, but it introduces counterparty risk. If the dealer faces financial difficulties, your claim might be compromised. Some investors hold silver through allocated accounts, where you own a specific bar or batch of bars that is held for you. This is safer in terms of counterparty risk, but it is more expensive. Some investors hold silver through a fund or through a brokerage account. In this case, you are not really holding silver. You are holding shares or a position that is supposed to track the price of silver. Think carefully about which of these you have chosen and whether it aligns with your actual objectives. If your goal is to own physical silver as insurance against broader financial disruption, then holding silver in an unallocated account with a dealer you have never visited is not the same as holding it. Every position you hold involves counterparty risk. This is the risk that whoever owes you money or is holding your asset for you becomes unable or unwilling to meet their obligation. If you hold silver with a major bank or well-established dealer, your counterparty risk is lower because these institutions have strong balance sheets and are regulated. If you hold silver with a small, newly founded online dealer, your counterparty risk is higher, but counterparty risk is never zero. The glitch we experienced is a reminder that even seemingly stable professional systems can fail. So it is worth asking yourself, how much of my wealth am I willing to entrust to any single institution? A reasonable answer for most investors is not too much. Diversification of custodians, the same as diversification of assets, is a practical risk management approach. Silver is volatile. At the time of this recording, silver trades in the high teens to low 20s per ounce, but it has traded as low as $4 and as high as $50 in recent decades. A significant move in either direction is possible. Have you sized your position such that a 10, 20, or even 30% move would be uncomfortable but not devastating to your overall financial situation? If you cannot handle that level of volatility without experiencing acute stress, then you may be overexposed. Position size is not just about mathematics. It is about psychology. You need to hold a position size that allows you to think clearly and rationally when prices move, rather than a position size that triggers panic. The glitch itself did not change the fundamental supply and demand for silver. It did not change the amount of silver in the world or the number of people who want it. What it did do is create a temporary disruption in the market mechanism that translates supply and demand into prices. The glitch was corrected. The market mechanisms that failed have been reviewed and, to some extent, improved. But the glitch is a reminder that market mechanisms are not infallible. If you hold silver for the long term because you believe it is undervalued, because you want insurance against monetary debasement, or for any other fundamental reason, then the glitch should not change your view. Prices will continue to fluctuate. Disruptions will continue to occur from time to time, but the underlying reason you hold silver remains valid. If you hold silver for short-term trading, on the other hand, the glitch should prompt you to reconsider. Short-term trading in commodities is extremely difficult, especially for retail investors, and especially during periods of disruption. The odds are structurally against you. Your costs are higher than professional traders' costs. Your information is slower, your reaction time is slower, you are competing against people and algorithms that are faster, smarter, and better capitalized than you are. The glitch did not make short-term trading impossible, but it did make it demonstrably more dangerous. Review your holdings, know exactly where your silver is, with whom it is held, and under what terms. If you are uncomfortable with your answer, make a change. Review your position size. Is it sized appropriately for your risk tolerance and your financial situation? Review your cost basis. What price did you pay for your silver? If the current price is substantially above your cost basis, consider whether you want to lock in profits by selling a portion. You do not need to sell everything. But reducing your position size is a legitimate strategy if you have realized significant gains. Review your exit strategy. Before you purchase silver, did you decide under what circumstances you would sell it? If not, decide now. This is easier to do in a calm moment than in a moment of panic. Finally, review your emotional relationship with your position. Do you check the price of silver multiple times per day? Does it affect your mood and your sense of financial security? If so, that is a sign that you are overexposed. Step back. Reduce the position. Remember that this is one asset among many in a balanced portfolio, not the entirety of your financial life. If you do not currently hold silver but you are considering it, the glitch raises important questions about whether now is the right time and how much silver is the right amount. Before you purchase any asset, you should understand clearly why you are purchasing it. What problem are you trying to solve? Are you concerned about inflation and want an asset that has historically held its value? That is a valid motivation. Are you concerned about currency debasement and want something denominated in neither dollars nor any other fiat currency? That is a valid motivation. Are you hoping silver will appreciate significantly in price and you will profit? That is a possible motivation, but it is more speculative and less defensible as long-term strategy. Are you purchasing silver because you see other investors making money and you don't want to miss out? That is not a valid motivation, and it is likely to lead to poor decisions. Knowing your motivation matters because it affects how you should think about timing and price. If your motivation is insurance against inflation or currency debasement, then the price of silver is less important than the fact that you own some. Whether you buy at $18 per ounce or $22 per ounce matters less than the fact that you own it. You might even consider dollar cost averaging, buying a fixed amount each month regardless of price, because it removes the pressure to time the market perfectly. If your motivation is to make money because you believe silver is undervalued, then price absolutely matters. You should have done extensive analysis. You should have calculated intrinsic value. You should have determined what price represents a good entry point and what price represents an overvalued situation. As of this recording, silver trades in the high teens to low 20s per ounce. Historically, over the past 20 years, silver has averaged somewhere in the mid to high teens, so we are at or slightly above the long-term average. This does not mean silver is overvalued. The long-term averages are not intrinsic value. They are merely averages. But it does mean we are not in a screaming bargain situation. We are in a relatively normal price environment, with silver neither dramatically cheap nor dramatically expensive. If you are considering entering the market now, You should do so with the understanding that you are not catching a historic bargain. You are purchasing at a time when silver has already recovered significantly from its lows. There could be further appreciation, but there could also be correction and a decline back toward previous lows. If you decide to purchase silver, you need to decide how to hold it. Physical silver? You purchase actual silver bars or coins and you store them securely. This gives you direct ownership and removes counterparty risk. It is low cost, assuming you're buying from a reputable dealer. The disadvantage is that you need to store it safely, and if you ever want to sell, you need to transport it or find a local buyer. Allocated account with a dealer. You purchase silver, and the dealer holds a specific bar or bars for you. You own the silver, but the dealer provides custodial services. This is safer than physical storage at home, but it has costs associated with storage and insurance. It also introduces minimal counterparty risk. Unallocated account with a dealer. You purchase a claim to a certain amount of silver, but you do not own a specific bar. The dealer holds a pool. This is the lowest cost option, but it introduces more counterparty risk. Silver fund or ETF. You purchase shares in a fund that owns physical silver or holds silver futures contracts. This is the most liquid option and the easiest to buy and sell. But you are not directly owning silver. You are owning a share of a fund, which is an indirect claim on silver. Silver mining stocks or leveraged silver products. These are more speculative options. They provide leverage and potential for greater returns, but they also introduce additional risks. For most retail investors, I would recommend either physical silver held securely by yourself or an allocated account with a reputable dealer. These balance the desire for security and genuine ownership against the practical concerns of storage and liquidity. How much silver should you own? The answer depends entirely on your financial situation, your risk tolerance, and your overall portfolio. A simple framework. Most financial advisors suggest that commodities should represent somewhere between 5 and 10% of a diversified portfolio. Within commodities, precious metals might represent a portion of that allocation. For some investors, precious metals might represent 2 to 3% of their total portfolio. For others, it might be 5 to 10%. Very few investors should hold precious metals as more than 20% of their portfolio, because this would create excessive volatility and risk. The glitch that we discussed is a reminder that concentration risk, having too much in any one asset or one market, can be dangerous. Diversification is your primary defense against disruption in any single market or asset class. Many investors have asked, should I wait? Should I see if prices fall before I buy? No one can predict short-term price movements. Anyone who tells you they can is either dishonest or deluded. The glitch did not change this fundamental truth. If anything, the increased unpredictability should make you more humble about your ability to time the market perfectly. If you have decided that you want to own silver, and you have determined an appropriate allocation for your portfolio, then the question is not, will the price go down, but rather, am I comfortable owning at this price, regardless of where it goes next? If the answer is yes, then buy. If you want to reduce your timing risk, buy gradually over a period of weeks or months. If the answer is no, then wait until you are comfortable with the price and the situation. If you're going to purchase silver through a dealer, do your homework on that dealer. How long have they been in business? A dealer with 10 or 20 years of history is more trustworthy than one founded last year. Are they a member of industry associations? Organizations like the Industry Council for Tangible Assets have standards and practices that members must follow. What are their fees? Compare across multiple dealers. Fees should be transparent and competitive. What are their storage and insurance practices if you're using an allocated account? Have there been complaints filed against them? Check the Better Business Bureau and online reviews. Are they insured against loss or theft? Do not be shy about asking questions. A reputable dealer will answer them directly. If a dealer is evasive, find a different dealer. Now I want to address directly the behavioral errors that cause investors to lose money, especially during volatile periods like the one we are experiencing. This is the most common and most expensive mistake. You see a price move that frightens you or excites you, and you make a trade based on emotion rather than analysis. During the glitch, many investors saw prices that were clearly wrong. Their emotional response was to sell immediately, locking in apparent losses. Then, when the glitch corrected and prices returned to normal, they were out of the market. The antidote to emotional trading is a written plan. Before you invest, write down your investment thesis, why you are buying this asset. Write down the price at which you would consider selling. Write down the conditions under which you would hold despite volatility. Then, when emotion strikes, you have your plan to reference. You do not make decisions based on how you feel in the moment. You execute the plan you made when you were thinking clearly. Leverage is the use of borrowed money to amplify returns. If you own silver outright, you are not leveraged. If you borrow money to buy silver, or if you trade silver futures with only a small fraction of the value required, you are leveraged. Leverage can amplify gains, but it also amplifies losses. A 20% decline in silver becomes a 40 or 50% decline in your capital if you are leveraged 2 or 3 times. During volatile periods, leverage positions are especially dangerous. A sudden move can trigger a margin call, forcing you to sell at the worst time, locking in losses. The simple rule: do not use leverage unless you have significant experience, understand exactly what you're doing, and can afford to lose the entire amount you have invested. For most retail investors, the answer is not to use leverage at all. We discussed this earlier. Having too much of your portfolio in a single asset or a single market magnifies risk. The glitch in the silver market was temporary and localized, but imagine if you had 50% of your net worth in silver positions. Imagine if those positions were held with a single dealer. A more severe glitch could have resulted in significant losses that you could not recover from. Diversification across asset classes, across geographies, across custodians is not exciting, but it is essential risk management. We mentioned this, but it is important enough to repeat. Every financial position involves counterparty risk. The bank could fail, the broker could fail, the dealer could abscond with your money. These things are rare, but they are not impossible. The banking system has built-in protections, deposit insurance, for example, but these protections have limits. Do not keep more with a single counterparty than you can afford to lose. Do not assume that because an institution is large and established, it cannot fail. History shows that large, established institutions fail regularly. Silver had significant gains in recent years. Investors look at those gains and think, I should have been there. I should buy now so I can participate in continued gains. But markets do not extrapolate. Just because silver went up does not mean it will continue to go up. Past performance is not predictive of future results. When you are attracted to an asset because of recent gains, you're typically buying near the peak. You are late. You're buying from people who are trying to lock in profits. You are betting that greater fools than yourself will buy it from you at even higher prices. Instead, focus on value. What is the asset worth? Is it fairly valued? Is it overvalued? Is it undervalued? Trade based on those assessments, not on past performance. Every time you buy or sell, there's a cost. There is a bid-ask spread, the difference between what you pay and what you would receive if you sold immediately. There are dealer markups. There are storage fees if you hold silver with a custodian. There are transaction costs. These costs seem small in percentage terms, but they compound over time. If you are trading frequently, costs will destroy your returns. Many retail investors do not fully appreciate how much their frequent trading is costing them. They focus on the price of silver, $19 or $20 or $21, and miss the fact that dealer markups and costs are eating 5 or 10% of their capital. Minimize costs by trading infrequently, using low-cost custodians, negotiating dealer fees, and accepting that a reasonable return minus costs is better than a theoretical return gross of costs that you will never actually achieve. No one knows where silver prices will be in 1 year or 5 years or 10 years. No one. Not me, not professional traders, not the largest financial institutions. Anyone who claims certainty is either ignorant or dishonest. The glitch demonstrates that even market participants with access to the best information and the most sophisticated tools cannot predict what will happen. Volatility and disruption are inherent to markets. Accept this uncertainty. Do not invest more than you can afford to lose. Do not bet your financial future on any single prediction. Build a diversified portfolio. Plan for multiple scenarios. Hope for the best, but prepare for the worst. Let me address something deeper than tactics and strategies. I want to address the psychology of living in uncertain times. We are living through a period of significant economic and social change. Central banks are experimenting with policies that have never been tried before. Geopolitical relationships are shifting. Technology is evolving at a pace that most people cannot fully comprehend. Inflation and deflation, security and danger, stability and disruption, all of these are topics of genuine uncertainty. In response to this uncertainty, many people become either complacent or panicked. Some convince themselves that nothing bad can happen and they take no precautions. Others become convinced that catastrophe is imminent and they make dramatic, often unwise financial decisions. The truth is more nuanced. Bad things can happen, but they are not certain to happen. Most of the time, most people get through most days without dramatic disruption. But periodically, disruptions do occur, and they can be significant. A mature financial approach accepts this reality. It prepares without obsessing. It hedges without panic. It diversifies without paranoia. The glitch in the silver market is a small example of what can go wrong. It is not the end of the world. It is not a certainty that it will happen again, though something similar might. It is, instead, a useful reminder that the systems we rely on are made by humans, operated by humans, and can fail. That is not a reason to abandon those systems. That is a reason to understand them, to diversify across them, and to maintain flexibility about how your money is stored and invested. The glitch provides an opportunity for a broader reassessment of your overall financial strategy. Ask yourself these questions. If a significant market disruption occurred, how would my life be affected? Would I lose my job? Would I lose my home? Would I lose my ability to pay for food and medicine? If the answer to any of these questions is yes, then addressing those risks is far more important than optimizing your investment returns. You need stable employment. You need a safe place to live. You need adequate insurance. These are your foundation. Second question, am I diversified appropriately? Do you have cash reserves? Do you have stocks? Do you have bonds? Do you have real estate? Do you have commodities? Do you have international assets? Diversification across all of these reduces your vulnerability to any single market disruption. Third question, are my positions sized appropriately? Is there any single position that is large enough that its decline would seriously damage your financial situation? If so, that position is too large. Fourth question, do I understand what I own? If someone asked you to explain in detail why you own silver or why you own any of your other investments, could you do it clearly? If not, you probably should not own it.